Good afternoon, everyone. This is Tony Whitbeck. I'm the CEO of Key Management Group, and welcome to today's webinar entitled Advisor Legacy, the Buyer's Experience. With us today, I have Todd Doherty. He's our Director of Acquisition and Legacy Planning, and he's going to walk you through some content. I also have John Sullivan. He's one of our executive coaches, and he's going to moderate today's panel discussion. Before we get into the content, I want to just spend a minute to give you an overview of the services that we offer at Key Management Group. The first is our executive coaching program, which is designed for the owner of the financial advisory business. The second is practice management, and this service is designed really for the entire team with a focus on the back office operations, roles, responsibilities, systems, processes, and workflows. We offer two different outsourcing services. We provide client meeting preparation. We do about 200 client meeting preps per week for advisors across the country. And we do financial plan production, and we do about 11 or 1,200 financial plans a year. And then we have some acquisition and legacy planning services as well. We have our Advisor Legacy platform, and most of you on today's call are buyers listed on our Advisor Legacy platform. And so this platform is where we help people buy and sell practices. We provide business valuations, and we have two different turnkey continuity plans to help protect your business in the event of death or disability. We do have some partner firms. Those are Ameriprise, Cetera, Concord, and Northwestern Mutual. And members of those firms receive a discount on some of our services, such as our business valuation. So that's just a high-level overview of the services that we offer at Key Management Group. And so what I'd like to do next is turn it over to Todd, and Todd's going to take you through some content, and then we'll get right to our panel discussion. So Todd?
Thank you, Tony, and thanks to all of you for joining us today. I'm sure we're all excited to hear from our panelists of successful and experienced advisors who have bought practices. But before we do that, I'm going to set the stage a little bit by talking about what's happening in the mergers and acquisitions market in our industry, what are some of the trends that you can expect, and so forth, just to provide a bit of a platform for today's discussion. We're really entering an unprecedented time in our industry and in the country in respect to mergers and acquisitions. The year 2020 has been projected to set an all-time record in the United States for the transfer of businesses. And that's primarily the result of the fact that the majority of businesses are owned by baby boomers who are now well into their retirement years. I think in our industry, we're probably about 2 years behind that trend, so maybe we might expect to see a peak of sales and acquisition activity in approximately the year 2022, but regardless, one of those dates is only 3 years from now, and the other one is only 5 years from now, and we can expect really an amazing amount of opportunity in that time frame, and that trend is projected to last until approximately the year 2030. Let's take a look at some of the metrics specific to our industry, and these were put together by Pershing, Accenture, and Cirilli. Of the 315,000 financial professionals in the U.S., they're expecting 4 to 5% that will retire each year for the next 10 years. I don't believe that's going to be a linear progression. My assumption would be based on the demographics of the baby boomer generation that we'll see a build to a peak, and again, that peak might be in 5 years, and then a high level of activity, but a decline in the number for another 5 years or so, approximately. The advisor's average age currently is 60 plus years old, and those advisors control the majority of the assets in the country, $2.3 trillion in assets, according to these reports. They're also projecting a fairly significant shortfall of advisors in our industry. As we know, the industry has done a relatively poor job of developing that next generation of younger advisors. And as it turns out, those who are giving our industry a try are quitting at a fairly high rate. The quit rate, as they report here, is as high as 25%. It's also interesting to note that only 21% of the advisors in our industry are under the age of 40. So with this significant opportunity is also going to come some significant challenges in, who is going to be available to take on all of these clients, how are they going to staff those practices, and so forth. So as is usual, there will be opportunity, but also challenges within that. We found another interesting study regarding who is acquiring practices, for what reasons, and also more interesting to me was the outcome of those acquisitions, how the advisors perceive them as being successful or not. So this study was published by NFP Advisor Services, and they looked at about 400 financial advisors, 100 of which had completed acquisitions in their career, or 25% of those. As you can see here, 58% were completed for growth, 28% to expand into a new territory. 60% of those had only one acquisition, and the other 40% had multiple acquisitions or had, long-term experience in acquisitions. The surprising part of this study to me, and it's surprising because it's contrary to our own experience, is that a fairly large percentage of these advisors, 45%, said that they were not satisfied with the results of the acquisition. 25% said that they were very satisfied, and another 30% were kind of in the middle there somewhere, saying that they were moderately satisfied. And again, that was a surprising result to me. And our feedback is admittedly anecdotal, but the majority of the feedback that I hear from advisors is that they were satisfied with their acquisition, and it actually exceeded their expectations. So that's a bit of a surprise, but the next slide, I think, is going to illustrate where those findings came from and why the results were what they were. So the same study looked into those two groups, those that were satisfied with the outcome and those that were not satisfied with the outcome, and they broke that down a bit, and I really appreciate this information because I think this shows the very distinct differences between those two groups. So let's look at a couple of these items. First, how long did it take to find a deal? Of those satisfied, they spent more time finding the actual deal that they closed, and only 33% found the deal in under 2 years. The not satisfied group had a shorter time frame to find a deal. 70% found the deal in under 2 years. And as I go through this information, I think, as I did, you'll probably start to see a trend here. And I think the trend is really around both the preparation of the advisor who's buying and the execution of the advisor who's buying. And I think what I see here in these statistics is, for those who weren't satisfied, both a poor preparation and a poor execution. And I think these items point that out pretty well. For example, the first item, and in respect to the time it takes to find, those who spent more time finding the right practice to purchase were probably about it and looking for a practice that suits their goals, as opposed to reacting to an opportunity for the sake of opportunity. The next item is the price point that was paid, and this might be a bit of surprise to people, but the satisfied group paid a higher price, essentially. They paid higher with higher multiples of revenue. The dissatisfied group paid a lower price. And again, that might speak to the quality of the practice, but I think it's another example of, probably people looking for any deal versus looking for high quality deals and the right deal. I won't go through all of these, but I'll touch on a couple more. In terms of the implementation, The satisfied group, 50% met with clients when they transitioned. And on the not satisfied group, 75% only informed the clients with a letter. Boy, and I think if you miss the boat on one item, the client transition would certainly be a really, really important step to do well. And sending out a letter, not meeting with those clients, and specifically not meeting with the clients and the seller for the introduction, is a really big mistake that hopefully none of you would make. Retaining the staff was another critical area of differentiation, and as you can see here, 57% of the satisfied advisors retained all staff, and only 19% of those not satisfied retained all staff. I think, again, this goes to the continuity of the client's experience. Normally the staff, specifically the assistants and the front desk people, are oftentimes really the face of the practice. And if you can retain those people at a minimum for a period of time when you can create relationships, then I think that's certainly a best practice that should be executed. And then lastly, in terms of client retention, you can see that 66% of the satisfied folks retain more than 75%, and only 13% of the dissatisfied ones retain 75% or greater, and that is really a terrible result. And I think that result is really the outcome of the rest of these areas that show very poor execution and preparation. And client retention should be greater, certainly greater than 25%. And in our experience, we have client retention rates, generally speaking, that are lower, or attrition rates that are lower than 5%, so 95% retention for most deals. So given that, it's good to know what things that you can do, and that's the reason for our panelist discussion today, for them to share their own best practices from the point of view of a buyer. What are those things that you should really pay attention to be successful in acquisitions? First, be deliberate and patient when finding deals. Really, the deals that you're looking for should help you achieve goals within your practice. It shouldn't be a situation where you're pursuing opportunity for the sake of opportunity, willing to buy any practice that has a for sale sign on it. I mean, you should really do the due diligence that's required to see, is this practice going to improve my existing business? Is it going to help me with long-term goals? And hopefully not just move you up in the rankings. Pay attention to fit, not just the deal. And I would point out that the fit is the most important thing for the seller. And if you pay attention to the fit, as you should, you're a lot more likely to close deals. In fact, that should be the primary focus of any acquirer when they're dealing with a seller or presenting their value proposition, is really about the fit, how they're going to take care of the clients and be a good successor for that seller. Leverage the outgoing advisor to make introductions. If that's not obvious, boy, that's just a critical step in the process. The better that you do with that transition, with those communications, client meetings, client events for the handoff, all of those things are going to add up to lower client attrition, a better experience, and probably a better long-term relationship with those clients. As we pointed out on the previous slide, retaining the key staff, I believe, is also important to the transition, and really anything that you can do to continue the experience of client service for that client for at least a period of time that you're establishing a relationship is critical. That could be retaining the staff, it could be retaining the office. At least having the clients go to a similar area is important, and not asking them to travel out of their area to a new location. Really anything that creates continuity in client service is going to help you be more successful. And then lastly, be proactive about planning the handoff. We spend a lot of time in that in our transitions of helping both the buyer and the seller make sure that the handoff of clients is successful, because it really is the critical piece in the transaction. As Tony pointed out, one of our key services is our Advisor Legacy service, where we're helping buyers and sellers while we represent the seller. We do spend a lot of time in that service helping both of them come to a successful deal. So the way that we define that success is pretty straightforward, I think. First, we look for a fair deal in terms, and I think it really has to be a deal that works for both parties. We're not in a position in our own sales to try to drive a hard bargain on somebody. We have a belief that if it doesn't make sense for the buyer and the seller, it doesn't cash flow well and so forth, then it's probably not the right deal. Then probably we have a bad match and we need to, find another better match. The acquisition from the buyer's perspective, again, should really fit into the buyer's strategic goals. And really the best acquisitions are those that help make the buyer's practice more efficient. It's pretty common that there's capacity in practices, and especially the larger ones that have associate advisors and so forth. And so if acquiring another client group or practice can use some of those existing capacities, it will make the practice more efficient, hopefully more profitable by doing so. And that's really where you generally find the best results for the buyer. The acquisition should serve the long-term strategic goals, of the business and ultimately enhance its value. As a buyer, and I would reflect on those opportunities as, how is it going to help me sell my practice in the future? If I acquire this practice, is it going to make my practice more attractive to a buyer when I'm ready to sell? Is it going to enhance the metrics of my practice? Is it going to ultimately make it more profitable? So someday when I'm on the other side of the transaction, it will be more valuable as a result of that activity. And again, just not simply for the sake of only increasing my GDC or AUM or moving up in the rankings. Certainly those are fairly superficial goals, I think. And really the more strategic goals should be those that the acquisition helps you achieve. So I think that hopefully sets the stage a little bit for our conversation. I'm going to hand it over to John Sullivan now. He's going to introduce our distinguished panelists and run through a series of questions with them. John?
Thanks, Todd. Appreciate it. Again, good morning or good afternoon, wherever you are in the country today. We appreciate you being on this call with us, and hopefully Todd and Tony have given you enough backdrop here to see how important this is and the timeliness of this. And the fact is that there's going to be huge opportunities for you as buyers, and so we want to be able to continue to give you, if you will, the best practices that we've experienced that might help you in pursuing acquisitions going forward. So we are really happy to have three colleagues of yours that have been successful in acquisitions and have had experience doing so to share with us some of their activities during their acquisition process. So we have Matt Thompson, who's out of Overland Park, Kansas. By the way, all three of our advisors are PWA members. Matt has been with us for 16 years. He's got a couple of staff members. He's got a 97% client satisfaction survey. We also have Charles Jones, who's part of Jones, Cannon and Associates out of Dallas, Texas. Charles has been with us for 15 years, 96% client satisfaction, and his organization includes 5 FAs as well as 7 staff members. And last but not least, we have Derek Kinney out of Arlington, Texas, 22 years with the firm, 99% client satisfaction, is also a member of the Hall of Fame, and has 7 staff members. So welcome, gentlemen. And what I'd like to do is we're going to have a round-robin discussion on answering some questions, and then we will have time at the end here so that we can open it up to people. But I think I'm going to start with Matt. And Matt, could you just, first of all, just tell us a little bit more about yourself, and what your previous acquisition experience has been. And Matt, you might be on mute, so you might need to come off of that before you start up.
Don, why don't you go ahead and start with Derek, because it looks like Matt somehow got disconnected on the phone line.
Okay,
so,
sure. No problem. Derek, why don't, again with you, tell us a little bit about yourself and previous experience with the acquisition process.
You bet, John. Thank you for having me on the call today, and I want to express what a joy it's been to work with you in my recent acquisition, which is now 3 months old and going very, very smoothly thanks to your support. So I appreciate that. In terms of myself, as you mentioned, I've been an advisor with Ameriprise for going on 22 years. Our focus is primarily retired clients that are really focused on living the best retirement they can. We acquired a practice back in 2009 that basically doubled our size, and that's where we really cut our teeth. It was a quality practice. The advisor was retiring, and it gave us a chance to really take the systems that we built and plug them into another location. And it wasn't without its hiccups, of course, but it worked very well in terms of growth. We had a large client retention with that practice, which was very good, and it really helped us grow quite a bit. But I think first and foremost, it allowed us to really structure our systems that we could expand almost in a franchise mentality, that we could bring on other practices in the future, knowing that our systems would sustain that type of growth. So we've had good experience so far.
Excellent. Thank you, Derek. Appreciate it. Charles, did you get on with us, and can you tell us a little bit about yourself and your experience with acquisitions?
Yeah, sure. Can you all hear me?
Yes, we can. Thank you.
Okay, great. Yeah, thanks again for having me on the call as well. And, you know, Key's been very helpful in our recent acquisition, and I'm not sure how we would have done it without them, so we always appreciate their support. As far as past history and transactions, what I would end up doing is buying partial practices, usually from advisors that were looking to cut some clients out of their practice, or they were, you know, beginning the transition to retirement and scaling down a bit. So I really worked hard on developing relationships with people that I knew would have a desire to do that, and was able to pick up some practices, you know, small stuff, you know, early on, and then realized that every time that I picked up one of those small practices, I mean, I had it paid off within 18 to 20 months, and I was like, okay, well, this is pretty cool, and I had a lot of success integrating the clients in the way that we did things without totally turning their world upside down from the way they were used to doing it, and that helped out a lot. The AFAs and the other things built within the practice are helpful when you do an acquisition, because you can shave off some clients and just direct them towards an AFA, as opposed to, you know, having to deal with selling them. So I think having that infrastructure in place is really helpful. We've got 2 office locations, one in Houston, one in Dallas. The Houston was an acquisition that we did in June of this year. It was a little bit of a challenge doing 2 locations, but I think with Key's help and then some general planning that we did on our own, it was a very smooth transition. We probably overthought it in a lot of ways, but it produced you know, a great result. And knocking on wood, you know, we've retained 100% of the clients, which typically doesn't happen, and you know, maintaining those 2 office locations. So it's worked out great.
Great. Thank you, Charles. And then Matt, were you able to rejoin us? Matt, you there? Okay, well, we'll come back to Matt. Hopefully he'll be able to join us. But let's go into the second question. And, you know, Todd earlier spoke about the fact that, you know, sellers only sell once. And so this is maybe the biggest transition they'll have in their career. It may be one of the biggest assets they have. And they really look at three things: price, terms, and fits. And so when you guys think about it from a buyer's point of view, how would you rank these three? How have you ranked these three, and what do they mean to you?
Hey, John, I think Matt might be back on now. Matt, can you hear us?
Can you hear me?
Yeah, we can hear you, Matt. Sorry about that.
Yeah, I'm not sure if it's my phone or my computer. We were talking earlier, but yes, I'm not sure where I came in, but I think just to quickly introduce myself, I've been with Ameriprise about, I think I'm in my 16th year, and kind of got out of college and did it the organic way for about 8 years, and stumbled into an acquisition opportunity that was pretty small, but something I took on, and it was an interesting learning experience. Kind of what Todd had alluded to, some of the wrong fits were present, but I was so excited about the deal that I went ahead and tried to tackle it, and it worked out okay from a financial standpoint, but like I said, I learned a lot along the way, and went on to another 6 or 7 years of organic growth before I acquired a practice through the Key Management Group, and had just a really, really good experience, almost doubling my book of business. At the time, I was probably in the neighborhood of $1 million GDC and $150 million under management, and was able to acquire business with about 800 or so GDC and 110 under management. It just went really, really well, because I think a lot of it was just the right fit at the right time, and associated with a good process that KMG promoted to help the buyer and seller come together successfully. So that was my quick intro, so thanks.
Thank you, Matt. Appreciate it. So we're going on to the next question about price, terms, and fit. And Charles, maybe you could share with us, how did you rank those, and did your priorities change actually through the process? Just talk a little bit about price, terms, and fit for you.
Yeah, great question. So I look at it as fit, and really fit. The price and the terms are not what I'm focusing on, at least in the beginning, because I think the biggest mistake that's made that I've seen in acquisitions is if you end up, purchasing something that isn't a good fit, it is not going to work out for you on price, terms anyway. And to clarify what that means is, if you've got I'm a relatively laid-back advisor, and I know others that are fairly high-strung and, are highly analytic, which is not me. So if I went and bought their practice is going to be a reflection of the people they are. So I want to try to find someone who matches up with the way that I do things. And the price and the terms can be great, but if you've got a highly analytic, high-drama advisor that sells their highly analytic, high-drama clients to someone who's not like that, it's not going to work out anyway. So it doesn't matter really what the price and the fit is. Now, price and fit matter. The price and the terms matter, but the fit is extraordinarily important. And one of the things that I liked about KMG is that you have these kind of initial conversations with the advisors when you're in the role of bidding on their practice, and I get a pretty good idea within the first 10 minutes. Is this a good fit or is it not? What are the questions this person's asking? Do their values match up with mine? Because guaranteed, if it is a person who's laid back, they more than likely have fairly laid back clients. You tend to attract who you are at your core, and you can get a really good idea about what a person's practice looks like just by asking them some key questions about what their values are. So once the fit's there, then I guess the next most important would be price, and the terms are pretty easy. I've never experienced a lot of drama or negotiation on terms. It's usually around price. But to give you an example, I'd say fit, and fit more than anything else.
Thanks, Charles. That's I like that a lot. Derek, how about your perspective on it when you think about your experiences?
I think Charles summed it up very nicely there. Nice job, Charles. I would say fit is very, very important. And what I would add to that would be, as deeply as you can, try to find out why the advisor is selling. What is their personal, what I would call why? Are they doing it for health reasons? Is it because it's part of their retirement plan? It's very, very important to really understand the mentality of the seller and what's truly important to them, and then you can really find that fit. And to elaborate further on that, I think it's important for advisors. I know with myself, I'm a very growth-oriented person, and I love a new challenge and the pursuit of just personal and professional growth. It's important to take a step back and analyze, is this practice a good fit for our existing structure with how our practice is currently set up, and are the clients that we may buy a good fit for me personally? So I think there's several levels of how I would define fit. If all of those can line up well, that can be a very magical experience and a magical practice. So when I think of fit, it's fitting in with, can my existing team handle this group of clients? Are they the same social style? Are there industries that we're familiar with? Are the processes similar? And also looking at the team itself that may be on the ground, how willing and I would say malleable are they to learning new systems? And I'll give you an example. A practice that we bought in McAllen, we finished the deal about 3 months ago. Super nice guy. He's my oldest and newest employee. And so he's been with the firm 9 years, but he's been with us going on 3 months. And we talk about the challenges of learning new systems, unlearning the old ones. So it's very, very important. I would say fit is good, but also price plays a big factor, knowing based on the assets, the recurring revenue, is this a practice I can afford, and will it put too much pressure on myself to have to pay for it? Because it's kind of like building a house. It can easily distract you from the main goal, and that is serving clients in the best way possible.
Yeah. All right. Lots of good takeaways from that, Derek. Thank you. And then Matt, how about for you? What's your experience been with price, terms, and fit, and how would you rank them, and did they change during the process?
Really almost identical to what the other two mentioned. I mean, just exactly that in regards to the fit, and also I think very, very important to understand why the client or the advisor is selling. And I have only two acquisitions, and one time I knew that answer and I knew why that fit with what I was looking for, and the other time I didn't. And that was a big mistake, and I think that's extremely important in just kind of understanding what the end result's going to look like. As far as, the fit goes, I think it's important to just have an honest understanding of who you are and what your capabilities are as an individual to take on, this type of opportunity and this type of stress. And for me, I don't have a big staff. I don't have 15 AFAs, and I don't really want to. And so for me, it was really important to make sure that if I was going to take on an acquisition, it needed to be the right kind of clients that I wanted to work with, because I couldn't really cut it up in my current structure and hand off the bottom 100 to another advisor. And I wanted to have the integrity to tell the client and the selling advisors that I was the one to work with them, because that was important to the seller, and AFAs are capable and all that. But for this particular seller, that was very important to him. And so for me, I just know that fit has to be important, and when I found out that it was the right fit, I just chased it down as aggressively as I possibly could, and positioned myself accordingly, because I knew it was going to be just a great win for all parties. And I think if it is the right fit, the advisor can win, the clients can win, and the retiring or selling advisor can win. And I think if all parties win, I think the important thing to the seller is that's what's best for them, especially if they're retiring, that their legacy is held intact. And I think that's important to these advisors that have built their careers helping people, and they want to be viewed in that light after they're gone. And so finding the right buyers, I know, important to them. So that would be my thoughts. Excellent. Well, that's well put, Matt. Thank you. So, Matt, let me keep you on the hot seat a little bit and ask you the next question. And it sounds like all three of you have had the experience of doing deals before working with legacy. So, as you think about legacy, how did your preconception of the process of actually acquiring through our system and our way of doing it compare to the actual reality of doing it? So it was. Well, yeah, that's it's interesting because I probably came into it a little bit different than some of the other folks on this call who are actively looking at acquisitions directly through this. I actually knew the advisor that was selling and had kind of courted that individual for a number of years. But obviously in this competitive landscape, there were other advisors that have also been courting this individual for a number of years. When 100 million plus changes hands at Ameriprise and SPS, people tend to try to get their hands on it. And so for me, I came into it kind of with, wow, this is now going to be this difficult process, but the process actually improved the end result of the transaction for both the buyer and the seller, and I wasn't necessarily the front runner in that. So when I came in, I had to kind of learn about key management, and one of the things I did that I really think was a wise thing was I went ahead and did an appraisal on my current business, and I worked with Todd to put that together just to kind of understand perhaps some of the things that sellers are seeing when it comes to the various pricing that goes into these deals. And I also did that with one of your competitors, and just to try to get an understanding of maybe the different valuation methodologies that are out there to help me with the bidding side of things. But once I learned about the process, it did go very similar to what I expected. I really appreciated, kind of the structured conversation that Tony led with the seller and the buyers as they were looking at that, and allowed us to ask some very specific questions and kind of flush out some of the concerns that we all have when we just look at a book of business and expect to make a huge decisions based on that and that alone. So once the process was started, it was very smooth, and I think pretty in line with what I expected. And I did have a few questions along the way, and I appreciate the way that key management worked with me on just kind of being an asset and being an advocate for both the buyers and the sellers. And I think they were looking for the right fit, and it's provided great price discovery for the selling advisor, as well as a confirmation of who he selected. So I think at the end of the process, because of key management, it gives the seller that confidence that they've come to that decision in a very disciplined way, and I think that helps with the transition, is just having that confidence that they didn't just make a decision because they had to. They went through a process, and they had help, and they vetted it out on both sides, and came to an agreement that made sense for all parties. So I thought it was a really interesting, and I'm glad I went through it, even if I wouldn't have got the deal. I think it was very well thought out.
Okay, great. Charles, same thing. How did your preconception of the process compare to the actual reality of going through it?
Yeah, I had gone through the process a couple of times before, so I had a pretty good expectation of what it was going to be. What I liked about, because this was the first one I did through Key. What I liked about that, I'd always been dealing with advisors directly without kind of the person in the middle directing traffic. And it is really, really helpful, especially if someone's retiring and this is their whole legacy, and it's what they put their heart and soul into, and they're good friends with a lot of the clients. It's nice to have the person in the middle. So if it's just two advisors there, a lot of times you can chase a bunch of rabbits around and not get a whole lot done in the process, and having an organized process, which Key does, to kind of keep things on track and checking in and going, okay, where are you guys on this stage? This is where you should be. This is our close date. That's just really, really helpful. So I knew it was going to be helpful because I'd never done one before, but it was more helpful than I expected.
Great. Okay. And then Derek, how about for you? What was your experience with it versus the actual reality?
I would echo what Matt and Charles both said. You go into this with an expectation, and sometimes it doesn't always turn out to be that way. With this process, working with your company, I thought it was a very orderly process. There's here's the description, here's when you should express interest, here's the bidding process. But candidly, I am not a very patient person, okay? And my wife will verify that. And what I felt like I wanted to do in this process was really campaign to pick me, because when I looked at a couple practices, I felt like we were a good fit. I didn't want to just sit back and let the process happen. I felt like I needed to make sure that I took control of as many variables as I could to position ourselves as a candidate of choice. So we had looked at about 3 practices, and through that process really refined our presentation, I would say our service model, what made us unique and different. And I liken it to almost running for office. I call it kind of a mayor's campaign where, if you want a practice, you need to kind of campaign for it. And what I did was I called the advisor very, very quickly and set up a phone call to begin building a relationship and begin building rapport to make sure that it was a good fit from day one. And so that initiative, I think, and I would encourage other advisors to do the same thing, it's important to be somebody that the person feels like they know you, like you, and trust you very quickly to establish a good foundation of what a future relationship could look like.
Excellent. Okay. Charles, what would you say was the biggest surprise?
The biggest surprise in the process, or
yeah, just your experience in either the process or acquisitions. As you just think about, is there anything that's really kind of been, didn't think about that?
Yeah, that's a great question. I was thinking when you initially asked it, I was like, man, I don't really have any surprises, but it turns out I did once I kind of thought about it. Is if you're buying a practice in another city from where you are, and you're going to maintain that office, and granted, I know not everyone's going to do that, you got to be very careful with some cultural differences in how they do business. So to give you a brief story on that, the process was fine. Integrating the clients is something I take a lot of pride in, and we make sure that, after the clients have landed, that we've got this full court press to meet with them all, immediately. Vacations, everything's off the table until we get FaceTime with all these people. Because you just put this huge investment down, and you want to make sure that you retain it, and the seller definitely wants to make sure that you retain it as well. I guess it's a minor thing, but the cultural surprise is that some people from Houston don't like people from Dallas, which was kind of funny. I assume we were all Texans. People from Houston don't exactly look at it that way. They kind of look at you as somebody who's coming down from the north to work with them. And so that was the only thing that really caught me off guard was there was a little pushback on the locality and where I was from. But it was more of a joking thing, but it actually exists. And it was probably the only thing that caught me off guard. I've done enough of these to the point where, I kind of know what to expect. When I was buying the practices earlier, I would run into some issues of I had an expectation that, I was going to gather all these assets and I was going to, get all these people into planning, and that expectation's not always met. So you got to be careful about, I'm going to pay X and I'm surely going to be able to produce Y, and not get too overconfident in your abilities, or you could wind up in a cash flow situation that you're not comfortable with.
Great. Yeah, that's a good point. Matt, what about for you? Any surprises?
I was kind of surprised how quick it all, just happened. I mean, it was a blur and a blitz. The seller in this case was just a stud, and he did it the right way in every way he could. And he had called every single client personally to explain to him why he was retiring, why he was selling, what he did as far as making sure he found the right fit for him. And he scheduled an introductory meeting with me as quick as he could the day of the transaction. And before the wire got to him of the price, we were meeting with clients doing the introductions, and we did 126 introductions out of the 135 top relationships that we targeted, which is almost the entire book, within literally like a 6 to 7 week period. And we got our spiel down, and he again cared greatly about the clients and the success of the business. And so my surprise was just how positive that handoff and transition was. I really couldn't believe how much goodwill that also gave us with those clients, as just, the way he presented it and the way he introduced me and my opportunity to have a first impression in that environment, and then establish the next, appropriate contact to get in front, really take it from there. And so with that, the retention was off the charts, and the surprise was we lost a couple people before we even had a chance to meet with them, because somebody at their church had been waiting for the advisor to retire for 20 years. And so even as hard as we tried to get in front of them, within a couple weeks, a couple accounts left. But out of the $111 million, we lost $4 million in the first 12 months, and the remaining clients brought on an additional $8 million. So it worked out really, really well, and the seller has 100% to do with that success. And so that goes back to the right fit and the right kind of personality fit too. And that goes to Charles. I think Charles made the comments about, being more of a laid-back advisor versus an analytical spreadsheet guy. I mean, it's good to have that rapport kind of ironed out, so that when you do get in the trenches, you're all kind of rowing the right direction and working towards the same goals. So that was, the surprise was just how quick it all just happened, and it was intense.
Good, great. Derek, how about you? Any surprises? Anything that stood out for you?
Two surprises for us. Our primary office is here in Arlington. We've got a satellite office in Richardson, but this acquisition is in McAllen, which is about an hour and a half flight away, right on the border of Texas and Mexico. And one of the surprises for us was just the technology challenges of linking a distance office with our core office, from phones to computers, staff systems and so forth, how things will get created and done. So we've worked through that pretty well, but that is something that I now can anticipate better for future acquisitions. I would say another surprise that we had was early on, we got a couple comments from clients that it felt like Walmart had scooped in to buy the local corner store. And that quickly gave us some good feedback that we wanted to peel back a lot of the glitz and glamour and just make sure that they felt like it's one-on-one, coming down to this area, a little bit slower pace, and really listening and taking notes on what it is they wanted for themselves. Building the rapport with the letters, the introductions. I would write a handwritten thank you note after each client visit. And the goal was just to build up rapport and trustworthiness as quickly as possible. But logistically, those were some of the surprises, not unattainable, but I think we've overcome them pretty well so far.
Okay, great. Because we're getting short on time, and I want to leave room for questions from our audience, I just want to go to the last two questions, and I'm going to open it up to the three of you. But the question is, given your experiences, what specific advice would you give an advisor that's contemplating acquisition? What would you say is most important? So I want to just open it up to the three of you, and we'll just do it real quick, and then we'll get to the last question.
Yeah, I'll jump in. This is Charles. I would say reasonable expectations is that, especially on your first one, things are not going to go right. And if you end up, I don't care how well you plan for it, if you end up having a cool head and don't get mired down in the minutia of the operations and just go see the people. Just go sit down with them, get FaceTime. I had clients that would tell us, well, the advisor always would come to our house. Well, guess what? I bought the client. I'm going to their house. In that first introduction, I'm not going to try to mold them into my practice. I'm going to replicate what the selling advisor did, and over time, phase them into the way that I run my practice. Because the last thing you want to do is come in guns blazing and be like, changing all your portfolios. You're now doing financial planning, and here's the fee. You're meeting in my office, and I don't meet on Fridays, and I never come to your house. You start throwing those things out there, and I've heard advisors do this, like, they got to mold to the way that I do business. You're not going to keep them, and you're sure as heck not going to get referrals from them as well. So have the expectation that you're going to have to mirror whatever that selling advisor was doing, and you better know what the selling advisor was doing. And if you know that and you have the reasonable expectation going in, I'm going to have to go to this person's house, or this person only meets on Saturdays, and I've seen them all, it will be successful. And I think, you know, the transition, the retention will be good as well.
Great. Derek or Matt, would you add anything to that?
This is Matt. I would just add the right fit, not the wrong fit, and I really did the wrong fit the first time around, and got excited about doing a deal just to do a deal, and I've seen that with some of my colleagues in the area now that they're seeing how important it is to get to scale. They're just chasing everything down. It's like a feeding frenzy, and they're throwing bids on stuff that just doesn't strategically, or just common sense says it doesn't work out. And I did that, you know, 8 years ago, and it worked out okay financially, but it was just a disaster, everything else. And so I'm glad I waited and didn't chase the wrong deal in between the next one, and the next one was the right one. And I would just be patient. If you can find the right one, grab it. If not, it's okay to say no.
Okay, great. Derek, any last words before we go to the last question?
Yeah, what I would add to that, I like what Matt and Charles both said there. I think a lot of us have kind of A personalities, and we're pretty goal-driven advisors. It's important to make sure that the practice we're pursuing aligns on our long-term goal path. You know, what is the purpose of this practice acquisition? Does it add value to our practice? Will it completely disrupt all that we've done and cause more chaos than wins? And I think if you can overlay the template of here's what we're about, a practice acquisition can be a really good fit. If it's not, if it's done for more the pursuit of just more GDC, or I want to move up in the rankings, while that can be a motivation, it's not always the appropriate template to judge a potential acquisition buy. So if it lines up, I would say pursue it, and pursue it aggressively.
Great. Last question to all of you is just, how does your experience as a buyer influence you in regard to thinking about and regarding the future sale of your own practice? Just leave that open to anybody who wants to answer that.
I mean, it reiterates fit, and I sound like a broken record with this, but it just reiterates the fact that the fit has to be there, and kind of alluding to what we've all talked about on the line today is that, you know, if you end up having the wrong fit, it tears all the foundations of everything you're trying to accomplish apart. And so for me, you know, as a buyer, and realizing how important that is, whoever I ultimately sell my practice to, you know, I don't care if it's the highest amount. It's going to have to be a fit piece of it. A lot of the practices I've been on and won, I've never been the highest bidder. I've always been like number 2 or 3, but the fit was better. And I was able to position myself as being a better fit than people that were throwing more money at the practice.
I would echo that. That the type of seller that picks you when you're a couple $100,000 less than the highest bid is the type of practice you want and want to align with. And I see it as I'll mention the individual's name because he deserves the credit. Mark Cook was the individual who retired, and he retired in the right way in every way, and he considered that as his last final act for his clients to make sure that they successfully transition to the right advisor for him, and his legacy will live on because of that. And if I ever retire, I'm fortunate enough to retire, I got to pay off this note first, but you know, I want it to be the same way, that I can walk away and have confidence that I was worried about the clients and not the highest bid, and I did everything that I possibly could to make, you know, their goals in the transition front and center.
Great. All right. Well, first of all, I want to thank all three of you for you know, bearing your souls and your thoughts and your best practices. I want to turn it back over to Tony Whitbeck and see where we go from here. So, thank you, gentlemen.
Thank you, John. Thanks to our panelists. That was some great insight. We are running a little short on time here, so I'm going to quickly go through our Advisor Legacy platform and the process. These gentlemen obviously are experienced at it because they went through the process. But what happens is when a seller wants to, or when an advisor wants to sell their practice, we meet with them to discuss what their plans are. And then what we do is we create a profile about their business. and then that profile is published on the platform. And so we have about 800 buyers that are currently on the platform. Once the buyers receive the new posting, they have the ability to express interest in the practice. And then our job is to work with the seller to review the profile of the potential buyers. And then we invite people to bid on the practice. We typically get between 10 to 20 people expressing interest in each practice. And then we'll usually ask 8 to 10 people to place a bid. And then we'll narrow that down to 4 or 5 people that we actually want to continue on in the process. So we ask people to bid before we start the interview process because we want to see really who's window shopping and who's serious. And we usually get a handful of bids that all come in relatively close. In fact, that's really our objective because we want the seller to focus on the right fit, not on the right dollar amount. So once we've identified those 5 individuals, then we'll start the interview process. And as Matt pointed out, we conduct the interviews between the buyer and the seller in a very structured way. And then ultimately, the seller chooses who they want to be their buyer. We finalize the terms and negotiations, and then what we do is we help them develop their transition plan so they can successfully transition those clients over typically a 4 to 6 month time frame. So we do charge a fee for our service, and we charge it to the seller, and the seller pays anywhere from 1.5% to 5% of the sales price, depending upon the size of their practice. So it's a sliding scale. So that's our Advisor Legacy platform and how it works. And buyers can join for free until they see something that they like. And then if you want to be able to place bids on a practice, you would have to become an elite member. And that's just $495 a year. And we actually offer half off for the first year, so it's only $247.50 for the first year. So what I'd like to do next is open it up to some questions. We do have some questions that have been typed in already. So the first question was, how many buyers per seller are you seeing in today's world, and is that changing? So I'd mentioned we typically get between 10 and 20 people that have expressed interest in a practice. It also depends upon the geographic area. So if you have someone that's in the corner of Wyoming, there might not be as many people that are interested than if the practice was in Chicago. So geographics does play a part in how many people are going to participate in that practice. John, were you going to make a comment?
The only other thing I would also say is that because we are finding more and more people buying outside of their, if you will, region or territory, that that's another issue. So you'll find that people tend to bid from outside of your local geography, which is becoming more and more predominant because of the large practices.
Great, thank you. Another question we had was, it says that it seems as though you generally represent the seller. Do you ever represent the buyer? The answer to that is yes. So in this platform, the platform is designed to help a seller find a buyer. But if a buyer already has a seller in mind, then we can work on behalf of the buyer. And so Todd will enter into a consulting relationship with the buyer to help you negotiate and analyze the deal. So that's really a separate service. It's our consulting service. So this particular platform of Advisor Legacy is designed to help a seller find a buyer. Todd, do you have anything to add to either one of those two questions?
Yeah, the second question, that's a good one. We do a fair amount of acquisition consulting, as Tony mentioned. And, as he mentioned, it's usually specific to someone who's either found a prospect in the seller, or they're in the middle of a negotiation but just don't seem to be making traction with the seller, and that's where we really come in and help structure the deal, define the terms, make an offer to the seller, negotiate the deal, really help it be successful. And we bring a lot of experience, as you can imagine, to the process. And I think it greatly enhances the probability of a close in the deal and helps both parties make sure that they get it right the first time.
Thank you, Todd. Well, it appears as though that's it for our questions today. So I would like to thank, again, our esteemed panelists for joining us today. We really appreciate your feedback. And Todd, for your insight to the content earlier on, and John for moderating today's panel discussion. As you can see on the screen, you can call us for a free consultation. We have a number 888-848-3349. You can go to our website to learn more about us at keymanagementgrp.com. And you can contact Todd directly, and you can see his contact information at the bottom right-hand side of your screen. So again, thank you, everyone. We really appreciate your time, and have a great day.